We are looking at a company that blends ancient, centuries-old Chinese cultural heritage, like hundreds of years of uninterrupted history, with some very modern, very high-stakes corporate governance dramas.
Right. We're talking about a massive structural accounting restatement.
Yeah, and a literal missing chairman.
Exactly. And to guide you through this, we have an exceptionally detailed stack of sources today.
So let's jump right in. Part 1, business analysis. Let's start with the absolute foundation. What does Wuliangye actually do? Well, they produce baijiu.
Right, which translates literally to white liquor.
Yeah, but honestly, that generic name does a massive disservice to what the thing actually is.
It really does. It is a traditional Chinese grain spirit.
Okay.
And the category itself is just incredibly diverse. But Wuliangye operates in a very, very specific, highly prized niche.
They make a strong aromatic baijiu, right?
Yeah, exactly, under their flagship brand. And the defining characteristic of this specific spirit is the blend. It's not a single malt situation. It is derived from 5 very specific grains.
Right. And looking at the sources, they list them as sorghum, rice, glutinous rice, wheat, and corn.
Yeah, that 5-grain blend is essentially their DNA.
It creates this complex flavor profile that, single grain spirits simply cannot replicate.
Right. And the fermentation process relies on that exact ratio. And they have structured this entire brand hierarchy around this specific liquid. At the absolute apex, you have the ultra-premium flagship lines.
Like the Wuliangye 501 and classic Wuliangye.
Exactly. These are the bottles that command astronomical prices. And then below that, they sort of cascade down into mid-tier and value-tier series.
Okay, so brands like Wuliang 1618, Wuliangye, Wuliangye, and Jianshuang.
Yeah, it's a classic halo effect architecture. You build unassailable prestige at the absolute top end, and that prestige kind of drips down to elevate the perceived value of the mass market bottles.
Which makes sense. And looking at the revenue mix, the success of that strategy is super obvious. A staggering 91.5% of their net sales come directly from the liquor.
Right.
But the remaining 8.5% comes from an ancillary packaging business, like glass bottles, plastic casing.
Yeah.
I gotta ask, why would a premium spirit brand bother running a low-margin plastics and glass business?
It's all about vertical integration.
Yeah.
I mean, when you are producing hundreds of millions of bottles, supply chain bottlenecks for physical glass can literally cripple your quarterly revenue.
Oh, wow. So it's a defensive move.
Exactly. But owning the packaging business, they aren't necessarily looking for a massive profit center, right? They are buying operational security.
That makes a lot of sense.
Yeah, they completely control the physical vessels their premium product sits in, which shields them from external supply shocks.
So functionally, 100% of their business is selling baijiu, with the 8.5% just acting as the logistical support to make the 91.5% actually happen. Okay, now let's look at where this liquid actually goes. Because the geography and customer base are overwhelmingly domestic. Substantially, all their disclosed sales are in mainland China.
Right. They distribute through a massive nationwide network of distributors, wholesalers, institutional B2B channels.
And they have expanded into over 56 international duty-free outlets, right? Covering over 100 countries.
They have, yeah. But to really understand the business, we have to understand the mechanics of consumption. Like, how is this actually consumed by the buyer?
Right.
Because it is structurally tied to formal occasions.
Yeah.
Baijiu of this caliber is not a casual beverage.
Right. You don't just pour yourself a glass of flagship Wuliangye while watching television on a Tuesday night.
No, absolutely not. It is deeply embedded in corporate gifting, high-stakes business entertaining, and formal banquets.
It kind of reminds me of, imagine champagne on New Year's Eve or a Thanksgiving turkey.
That's a great comparison.
Like, if you host a formal New Year's party and serve tap water, you have fundamentally failed the social contract of the event.
Exactly. You'd be laughed out of the room.
Right. But for high-end baijiu, that level of required, almost mandatory cultural presence applies to official business banquets and high-level negotiations. It's essentially the social lubricant of commerce and relationship building in China.
And because it is so deeply tied to those specific formal scenarios, the product is highly, highly sensitive to macroeconomic and cultural shifts.
Like if the economy slows down.
Right. If businesses tighten their belts or if official entertainment budgets get slashed, the baijiu sales contract. It is a discretionary premium good that is directly tied to the velocity of business networking.
And historically, that velocity was constantly accelerating, wasn't it? For years, this thing was an unstoppable pricing machine.
Oh, absolutely.
I mean, between 2016 and 2020, they were raising the ex-factory price of their flagship product by roughly $50 per bottle every single year, moving from RMB 679 to RMB 879 without losing any volume.
Which perfectly defines pricing power. When you can raise your price by $50 annually and distributors are still begging for allocation, your brand is acting as a Veblen good.
A Veblen good meaning demand actually increases as the price goes up, right?
Yeah.
Because of the associated status.
Exactly. It's a flex to buy it.
But the sources reveal a pretty critical shift. We are in 2026 now, and the music has kind of stopped. They're currently playing defense.
Yeah, they really are.
Management is lowering invoice prices to their distributors while simultaneously trying to hold the public wholesale reference price flat at RMB 850. Can you break down the mechanics of that maneuver?
Sure. So it's essentially a margin squeeze designed to protect the brand's aura. They want the end consumer to see that price tag at RMB 850, preserving all that prestige we talked about.
Right, keeping up appearances.
Exactly. But Behind the scenes, the distributors are really struggling to sell it at that price. So to prevent the distributors from panicking, dumping the product at a discount, and ruining the brand image, Wuliangye quietly lowers the wholesale cost.
I see. So the distributor makes a slightly better margin, Wuliangye takes a hit, but the public price stays firm.
You got it. It's a defensive crouch, masking a structural oversupply. The macro reality detailed in the report is honestly pretty harsh.
Yeah, the numbers are wild. 18 out of 20 listed baijiu companies posted year-over-year declines in both revenue and profit in 2025.
Right. The entire industry is basically grinding through this massive destocking cycle. Management explicitly attributed their 2025 downturn to a deep industry adjustment cycle. The consumption occasions, the banquets, the corporate gifting, they all just contracted sharply.
So a product completely embedded in hundreds of years of culture is hitting a brutal, modern economic wall. To survive a sector-wide contraction like that, a company relies entirely on the depth of its competitive advantages. Which brings us to part 2, moat analysis.
This part is fascinating. The equity report classifies the moat size as wide, but critically, the moat direction is narrowing.
That is a dangerous, almost contradictory combination. Let's explore the wide aspect first, which is rooted in their intangible assets. The sheer physical history is staggering.
It really is.
The report details these cellar clusters, the literal physical pits where the grain ferments that have been in continuous use since the Yuan and Ming dynasties. We are talking about over 700 years of continuous operation.
Yeah, and the mechanism of baijiu fermentation is highly dependent on the microflora, so the ambient yeast and bacteria that live in the walls and the mud of these ancient cellars.
Wow.
You cannot simply build a new concrete warehouse somewhere, toss in some grain, and replicate the flavor. The microecosystem takes centuries to develop. It is terroir, taken to an absolute extreme.
That is wild.
Yeah, the fermentation process itself traces back roughly 1,000 years in that specific geographic region.
And UNESCO and the UN FAO actually recognize the Yibin region as being uniquely suited to this production style. You literally cannot uproot this factory and move it to a cheaper labor camp.
You just can't.
And that geographic and historical luck translates to immense brand equity. I mean, they're ranked 18th on the Brand Finance 2025 China 500 list, and the brand alone is valued at $27.78 billion. Plus, they possess EU-China geographical indications protection.
Right, it operates very similarly to champagne or cognac in Europe. The name is legally protected, and the production method is geographically bound. That creates an incredibly wide, historically fortified moat against any new entrants.
Here's where it gets really interesting. How does a 700-year-old, $27 billion historical moat start narrowing in a matter of months? The cellars didn't collapse. The microflora didn't die.
Right, the physical product is perfectly fine. What's fascinating here is that the physical product remained entirely untouched. The erosion occurred entirely within the trust component of the brand.
Trust.
Because a heritage brand's moat is psychological. The report highlights a dual shock that fractured that psychology in early 2026. First, the company issued a same-day earnings delay, which was then followed immediately by a massive revenue restatement.
Yeah, we're definitely going to dissect the accounting mechanics of that restatement later, but fundamentally they told the market that their previous financial success was an illusion.
Exactly. And concurrently, an active corruption investigation was announced into the sitting chairman.
So the custodians of this 700-year-old national treasure suddenly appeared financially unreliable and, well, legally compromised. The psychological moat just cracked.
And the report explicitly notes, there is no network effect here to save them. A network effect is when a product becomes more valuable as more people use it, like a social media platform or a payment network.
Right, like a credit card.
Exactly. Baijiu doesn't have that. My enjoyment of a glass of Wuliangye doesn't increase just because you also bought a bottle. Furthermore, there is no low-cost production advantage. They boast gross margins around 77 to 79%.
Wow, yeah.
They aren't trying to underprice the competition through manufacturing efficiency, you know?
No, they compete entirely on premium pricing, prestige, and institutional trust. If I am buying a bottle for a state banquet to impress a dignitary, I am buying the flawless reputation of the brand.
Exactly.
But if the chairman is under investigation and the accountants are shredding the ledgers, that flawless reputation is tarnished. I might choose a competitor's premium bottle instead.
Yeah, absolutely. And the switching costs are also narrowing. Historically, these decades-long, deeply entrenched distributor relationships created massive friction for competitors. But management recently acknowledged price confusion and severe user experience issues on their newer retail platforms.
Really?
Yeah, they're actively fighting unauthorized e-commerce resellers and counterfeit products leaking into the market.
So they are losing their iron grip on channel discipline. A buyer goes online, sees conflicting prices for what is supposed to be a standardized luxury good, and the prestige just evaporates.
It completely vanishes.
So we have a historical moat under unprecedented pressure from governance failures, channel leakage, and a macro downturn. They clearly cannot rely on the old playbook of selling exclusively to corporate banquets. They must find new avenues for the liquid, which leads us to part 3, long-term growth drivers analysis.
Right, because when your core market contracts, survival dictates expansion into adjacent markets. So the company introduced a comprehensive pivot at their December 2025 distributor conference, which they titled the 5 New Expansion Strategy.
5 new expansions. Okay, they are targeting new consumer groups, new distribution channels, new consumption scenarios, new markets, and new internal mechanisms. Let's look at the geographic wins first, because the numbers here suggest the brand still possesses immense latent power.
They really do.
They achieved a remarkable 27% year-over-year sales growth in third-tier cities and rural markets in 2024.
Which is huge. The coastal Tier 1 cities, places like Shanghai or Shenzhen, might be saturated or disproportionately feeling the macroeconomic austerity pinch right now. But wealth creation continues in the deeper, more rural parts of China.
Right.
That 27% growth indicates that when affluence rises in lower-tier cities, Wuliangye remains the aspirational purchase. They still want it.
And they're also pushing outward globally. The Hime Global Tour reached 18 countries and regions. The report even notes a July 2025 partnership in Frankfurt, where they integrated Chinese visa services directly with brand experiences. That is just a fascinating exercise in state-adjacent soft power marketing.
It is, yeah. The geographic expansion metric is rated strong, precisely because they're finding new eyeballs.
Oh.
But, and this is key, there's a defensive reality shadowing this.
Okay, what's that?
Geographic expansion is strong, but pricing power, the ability to extract more margin from existing customers, is weakening. A July 2024 UBS note explicitly warned of a potential 17% drop in wholesale prices by the end of 2025, driven entirely by industry oversupply.
I have to push back a little on the optimism of this expansion strategy then. Selling high volumes in third-tier cities or pushing into the low-alcohol, ready-to-drink options that the broader industry is currently experimenting with, can that truly replace the high-margin, prestige corporate banquet sales they're bleeding?
That's the big question.
It feels like a high-end steakhouse trying to make up for lost dinner reservations by selling massive volumes of ground beef out the back door.
That is a perfect analogy. That is the existential tension within their growth model right now. Volume does not equal margin.
Right.
A bottle sold in a Tier 3 city might require significantly higher marketing spend or distributor incentives to move, compared to an automatic allocation to a massive institutional buyer in Beijing. The volume growth masks a potential degradation in the quality of the earnings.
And the new internal mechanisms they mentioned, that's just an attempt to wrangle their unruly distribution network back into submission, addressing that online price confusion we discussed earlier.
Okay.
But to evaluate whether any of these new expansions or mechanisms are actually working, we have to strip away the marketing language and look at the structural financial phase the business currently occupies. Which brings us to Part 4, business phase key metrics.
Right. And the report evaluates Wuliangye as being in Phase 5, capital return.
Let's define that for a second. A company in a capital return phase is no longer a hyper-growth startup burning cash to acquire users.
No, not at all.
It is a mature, deeply entrenched enterprise whose primary mandate is taking the massive amounts of cash it generates and returning it to the shareholders, typically through dividends or buybacks while maintaining the core operations.
Exactly. But the scorecard for this particular Phase 5 company presents an incredibly confusing, almost paradoxical set of metrics. We have these flashing red warnings sitting right alongside glowing green indicators.
Yeah, the red metrics are terrifying on the surface. The 3-year revenue compound annual growth rate, the CAGR, which measures the smoothed annualized revenue growth over the past 3 years, is negative. And the return on invested capital, or ROIC, which measures how efficiently management uses cash to generate profits, is sitting at a dismal 7.3%. If you run a standard automated stock screener, those 2 red flags automatically disqualify the company for most growth or value investors.
Oh, instantly. A negative 3-year revenue trajectory and a 7% ROIC basically suggests a business in terminal decline, just destroying shareholder value.
But the green metrics fundamentally contradict that narrative.
They completely do.
Free cash flow to net income is sitting at an astonishing 310%. And EBIT to interest expense, which is a measure of how easily they can pay their debt obligations, is 320x. They are functionally debt-free.
So you have to ask, how can a business with shrinking revenue and terrible capital efficiency throw off 310% of its net income in pure, unencumbered free cash flow?
Right. The math is broken. And it's broken because of a massive distortion in the data. The red metrics are a mechanical illusion.
Yep. The April 2026 restatement artificially poisoned the trailing data. Because management retroactively erased half of their 2025 revenue on paper, any metric that looks backward, like a 3-year CAGR or a trailing ROIC, is dragged down into the red by that single massive accounting adjustment.
If we look at the clean, unrestated data prior to the disaster, the reality is starkly different, isn't it? In FY 2024, revenue grew by 12%. That was their 5th consecutive year of double-digit top-line growth. The unrestated return on equity was a robust 23.9%. The underlying business engine, prior to whatever accounting maneuver occurred in 2025, was incredibly strong.
It was, which really highlights why understanding cash flow is paramount when analyzing a restatement. You can alter the timing of when revenue is officially recognized on an income statement. You can shuffle paper profits from one quarter to the next,
right?
But you cannot fake cash entering the bank account. Despite the massive headline net income cut, the actual free cash flow generated in FY 2025 stood at an impregnable RMB 27.7 billion.
The cash is a hard, indisputable physical reality. You can restate revenue, but you cannot restate the cash in the vault.
Exactly.
The cash business held up immensely better than the headline profit and loss statement suggests.
It did. However, and this is a big VisTef fan, however, while the cash flow proves the business isn't bankrupt, the fact that management felt compelled to execute an accounting adjustment of that magnitude points to severe external pressures forcing their hand.
Which directs us to look explicitly at those external threats. Moving to Part 5, risk analysis. Overall, the equity report rates the risk as medium, but the specific subcategory of outside forces is rated high and trending upward.
Yeah, because operational risks like supply chain hiccups or changing consumer tastes are generally manageable for a company with $120 billion in the bank. Yeah. The acute danger originates from factors they cannot control.
Let's examine the governance shock because the timeline is just staggering. In late February 2026, Chairman Zheng Kongqun came under active investigation for suspected serious discipline and law violations.
And this was not an isolated anomaly, which is the crazy part. The report highlights that his immediate predecessor, Li Shuguang, faced a similar investigation on comparable grounds just over a year prior, in January 2025.
Wait, 2 chairmen in 2 years. So what does this all mean? We have a repeat pattern at the apex of a state-controlled enterprise. This resulted in a literal leadership vacuum.
Yeah.
The company operated without a permanent, confirmed chairman for over 2 months. And look at the timing. They were leaderless at the exact moment they were executing a massive revenue restatement. They faced a historical crisis of financial credibility, and the captain's chair was empty.
It's wild. But we must contextualize this impartially within Beijing's broader macroeconomic policies. The government has initiated sustained anti-corruption and austerity campaigns.
Right.
And from an analytical perspective, we treat this strictly as a macroeconomic demand factor. We're not taking a political stance here.
Exactly. Regardless of the political mechanics, when a government enforces strict austerity and heavily scrutinizes lavish corporate or official spending, it directly curtails the demand for premium banquets and high-end gifting.
Yeah, the demand just evaporates.
It acts as a severe macroeconomic headwind for the entire baijiu sector. It is the primary catalyst driving that 15% category-wide sales drop across those 18 listed companies we mentioned earlier.
It creates a structural dampener on Wuliangye's core historical growth engine. So the critical question becomes, how does an enterprise survive a 2-month leadership vacuum, a 15% industry-wide demand contraction, and the internal chaos of a 50% revenue restatement?
And the ultimate mitigant is the balance sheet. It is an absolute fortress. The accumulated weight of their historical success is what insulates them from the current crisis. The specific numbers are almost difficult to process.
Let's hear them.
They hold roughly RMB 127 billion in cash and cash equivalents. Set against that, they have under RMB 1 billion in total debt.
That is just insane.
Yeah.
That net cash position of over 126 billion RMB grants them functional immunity to short-term credit crunches or high interest rate environments.
Right.
They can finance their own survival indefinitely. They have the financial runway to outlast the governance storm and the industry destocking cycle, buying them the time necessary to fix the operational leaks.
But, hearing terms like massive restatement and accounting correction naturally instills deep paranoia about the validity of that balance sheet. I mean, if they restated the revenue, what else is fake? We have to stress test the books directly. Which brings us to Part 6, balance sheet red flag checker.
Right. The protocol utilizes a standard 5-point mechanical check to scan for hidden structural landmines. And on the surface, the automated output looks exceptionally clean.
4 out of the 5 checks are solid green. Goodwill, which often represents overpaid acquisitions just waiting to be written down, is functionally non-existent at just RMB 1.6 million against 190 billion in total assets.
Yep.
Debt is completely dwarfed by the cash pile. Retained earnings, representing cumulative historical profits saved by the company, are massively positive at 113.4 billion. And there is no preferred stock complicating the equity structure or draining cash flow ahead of common shareholders.
The single moderate yellow flag was accounts receivable growth, simply because the outstanding IOUs from distributors fell at a slightly slower rate than the overall revenue fell. But honestly, a standard algorithmic screener would rate this balance sheet as flawless.
But the standard algorithmic checklist completely misses the actual existential risk here, doesn't it? It misses the hidden bombshell entirely.
Because standard checks are designed to identify dangerous leverage or inflated asset valuations. They are not programmed to detect retroactive adjustments to the timeline of revenue recognition.
We need to explain the exact mechanics of what happened on April 30th, 2026. Management released a correction notice. They retroactively slashed their consolidated Q1 through Q3 2025 revenue.
Yes, slashed is the right word.
It dropped from RMB 60.9 billion down to RMB 30.6 billion, a roughly 50% vaporization of top-line revenue. And the impact on the bottom line was catastrophic. 9-month net profit was revised down from RMB 21.5 billion to RMB 6.5 billion, a 70% cut.
And the justification provided by management cited a principle of prudence for revenue recognition timing.
Okay, what does that actually mean in the context of selling wholesale baijiu? How do you accidentally count 30 billion RMB early?
Well, it really hinges on channel scuffing versus consumer sell-through. Historically, baijiu companies often recognize revenue the moment they ship the pallets to their wholesale distributors.
Oh, I see.
The distributor assumes the inventory, the company books the revenue, and the manufacturer's job is done on paper. But if the end consumer isn't actually buying the bottles from the distributor, the channel backs up.
Yeah.
The distributor just has warehouses full of unsold baijiu.
So, by invoking the principle of prudence, management essentially admitted they had stuffed the channel. They reversed the revenue they claimed when shipping to the distributor, deciding they could only ethically recognize that revenue when the distributor actually managed to sell the bottle to an end consumer.
Exactly. They basically deferred the timeline. Crucially, though, they emphasized that this accounting change did not alter the cash flow statement. The cash had already changed hands between the distributor and the company. The adjustment purely dictated when that cash could legally be labeled as revenue and profit on the income statement.
Okay. Imagine you own an incredible, sprawling mansion. It is fully paid off in hard cash. You hold the deed. There is no mortgage.
Go.
That represents Wuliangye's balance sheet and cash pile. It is pristine and real.
Wow.
But suddenly you discover that the original appraisal of the house's value, the document telling the world how much wealth you generated last year, was completely fabricated by your accountant.
Wow.
The physical house is still there. You still have no debt, but your trust in the appraiser, in management's ability to truthfully report their performance, is totally ruined.
That's a really good way to put it. The leverage risk is zero. The physical assets are real. But the earnings recognition quality and corporate governance risk is immense. The danger isn't originating from creditors demanding repayment. It's originating from the boardroom's internal reporting mechanisms.
And valuing a company when management just erased half a year's earnings on paper is an absolute minefield. Automated screeners pull polluted data, leading to wildly inaccurate assumptions, which necessitates a manual breakdown of the valuation. Moving on to Part 7, Company Valuation Metrics Analysis.
Yeah, because utilizing the wrong time frame for these metrics will completely distort your understanding of the company's worth.
The primary metric for a Phase 5 capital return company is the price-to-earnings ratio, the PE. To calculate this accurately, the report uses a trailing 12-month, or TTM, basis. This is critical because it incorporates the clean, unrestated Q1 2026 recovery data. At a share price of roughly RMB 74.27, the TTM PE sits around 23x.
Which for a dominant, high-margin consumer staple operating within a wide historical moat, a 23x multiple is very reasonable. It reflects a mature business generating stable profits.
But the report explicitly warns investors about a massive trap hidden in the data screeners, right?
A huge trap. If an investor blindly pulled the FY 2025 restated earnings per share, which collapsed to RMB 2.31 due to the prudence adjustment, and calculated a PE based solely on that flawed year, the multiple would explode to an artificially high 32x.
And at 32x, the stock looks incredibly expensive and overvalued. But that number is a mirage, an artifact of the deferred revenue recognition.
Exactly.
By blending in the Q1 2026 quarter, where revenue recognition normalized, the 23x multiple emerges as the accurate reflection of their true earnings power. But PE still relies on accounting definitions of earnings. Let's look at a metric immune to accounting adjustments.
Right, which brings us to the secondary metric, price to free cash flow, or PFCF. Cash flow cannot be retroactively deferred by a principle of prudence. The cash either entered the bank or it didn't. And the PSCF is significantly cheaper, sitting between 10x and 11x.
If we connect this to the bigger picture, the massive canyon between a PE of 23 and a PFCF of 10 reveals the underlying truth of the restatement. It proves conclusively that the dividend is safely backed by actual hard cash generation, not manipulated paper profits.
Exactly. And in a Phase 5 capital return profile, the dividend is the primary mechanism for shareholder value. They offer a forward yield of roughly 7.0%. Furthermore, management committed to a minimum annual cash dividend payout of RMB 20 billion from 2024 through 2026.
Wow, 20 billion. They're essentially barricading the stock with a massive yield, daring investors to walk away from a 7% guaranteed payout while they fix the internal governance. We have phenomenal cash flow and a towering yield, running headfirst into a fog of governance chaos and restated revenues. Let's examine how the broader market has priced that whiplash. Part 8, Price and Sentiment Analysis.
The market's reaction definitely prioritized the governance shock over the cash flow safety.
Oh, totally. The price chart from mid-2025 through July 2026 is a devastating downward slope. The stock plummeted roughly 44% from its 52-week high, dropping from RMB 131.85 down to the RMB 74.27 range. Crucially, it significantly underperformed the local benchmark, the SSE Composite.
Yeah, the broader industry destocking cycle initiated the slide, but the sell-off accelerated violently when the chairman's corruption probe was announced in late February.
And then the floor fell out, right?
Yeah, the floor fell out entirely when the 50% revenue restatement dropped on April 30th.
But here's the crazy part. Despite a 44% destruction of market cap, an accounting scandal, and an empty chairman's seat, the professional analyst sentiment remains bizarrely optimistic. It is a consensus buy. We are seeing 11 or 12 buy ratings against just 5 to 7 holder sells.
Right.
The average 12-month price target hovers between RMB 100 and 107. That implies a massive 35% upside from the current suppressed price. Why the disconnect between the crashing stock and the optimistic analysts? Let's analyze the bulls versus the bears.
The bear thesis is pretty straightforward and relies on structural reality. They focus on the macro baijiu downturn. A sector where 18 of 20 companies are shrinking faces a secular demand issue, not just a temporary hiccup.
Makes sense.
Furthermore, a 50% revenue restatement permanently damages management credibility. The bears argue that if the earnings quality is suspect, the stock is uninvestable at any multiple.
The bull thesis, however, hinges entirely on the velocity of the recovery. The bulls point directly to the Q1 2026 numbers. In that single quarter, revenue surged 33.67% and net profit exploded upward by 82.57% year over year.
Right, because the bulls interpret the 2025 restatement as a classic kitchen sink maneuver. Management grouped all the historical bad news, the channel stuffing, the accounting adjustments. They threw it all into one catastrophic year, clearing the decks.
So they take the hit all at once.
Exactly. That allowed them to start 2026 with a clean slate, utilizing their unbreakable balance sheet to support the massive 7% yield, while the underlying cash generation stabilized much faster than the market anticipated.
But, analyst price targets are ultimately just opinions published in PDFs. To gauge true conviction, we must track the actual deployment of capital. Who is actually buying the blood in the streets? Which leads us to Part 9 insider, super investor, and company buyback activities.
Right, and while the broader market was fleeing the stock, the dominant institutional players initiated massive acquisition programs.
We lack a centralized U.S.-style insider tracking database for the Shenzhen exchange, but the substantial shareholder disclosures paint a very clear picture. The primary actor here is the state. Sichuan Yibin Wuliangye Group, which is a subsidiary acting as a proxy for the state parent company, which collectively controls roughly 55% of the shares they have been buying aggressively.
Yeah, they executed an RMB 800 million open market purchase between April and September of 2025. But the most critical signal arrived in May 2026, immediately following the April restatement and the subsequent stock crash.
What did they do?
The parent company pledged to purchase another 3 to 5 billion RMB in the open market over a 6-month window.
Wow. And that state-level intervention runs parallel to the company's internal treasury actions. On April 30, 2026, the exact same day they announced the catastrophic 50% restatement, Wuliangye authorized an 8 to 10 billion RMB share repurchase program.
It's massive.
It is. That massive buyback represents roughly 2.5% to 3.5% of their total market capitalization.
And we have zero disclosed transaction data from the CEO or CFO, and obviously no buying from the vanished chairman. But the combined firepower of the state parent and the company treasury is immense.
This raises an important question. Is a combined 15 billion RMB authorization a desperate state-mandated bailout designed to artificially prop up a failing national champion? Or is it a ruthlessly calculated value investment by insiders who know the cash flow is secure?
Either interpretation confirms a massively costly signal. The state is willing to deploy up to 15 billion RMB. This heavily implies that the ultimate controlling shareholders view the governance scandal and the prudence restatement as a transient disruption.
Right.
They're leveraging their 127 billion RMB cash pile to buy back a structurally sound, wide moat asset at a historically depressed 44% discount.
It creates the ultimate analytical paradox. You have a fortress balance sheet immune to debt, a towering 7% dividend fully funded by 27 billion RMB in free cash flow, a state parent actively deploying billions to absorb the retail panic. But all of this quantitative perfection is shrouded in an incredibly dense qualitative fog.
Yeah, a really dense fog.
An accounting restatement that erased half a year's performance, a macro environment hostile to luxury banquets, and a leadership vacuum triggered by anti-corruption probes.
The investor must weigh the quantitative safety of the cash against the qualitative risk of the governance.
And that profound tension is where the true analysis happens. It leaves you, the listener, with something vital to ponder as we close this file. What happens to the fundamental essence of a 700-year-old cultural artifact when it collides head-on with the demands of modern financial engineering and the realities of economic austerity?
That's a great question.
Can a brand forged in the Ming Dynasty survive the structural missteps of its modern caretakers? Does the ancient microflora in the fermentation pit ultimately matter more than the signatures in the accounting department? That is the multi-billion-dollar question for Wuliangye Yibin. Thank you for joining us for this deep dive. We hope it provided a new framework for evaluating heritage, risk, and the true mechanical reality of a balance sheet. Until next time, take care.
Thanks for listening.